Hello friends, in this video I will talk about why you need to stop contributing into your RRSP account. Now I know I've previously created videos and preached that RRSP is one account which offers you the highest returns amongst all other investments and saving accounts which are offered by the Canadian government, especially when compared to TFSA. However, there is a limit to which you should be contributing into this account. Now, I am not talking about the limit which is imposed by the government, which currently is somewhere around $20,000. No, I'm not talking about that limit. You have to determine the limit yourself based on your income earnings and what you expect to get or take out in your retirement. And I will run you through that entire math. Because what you don't want is that you contribute in this account so much that by the time you start taking out the money from this account, you're not able to take out the entire money. Or even if you're able to take out the entire money, it comes at a higher cost. Now, what do I mean by that? Let me go to the basics. RRSP contributions give you a higher return versus TFSA when the tax rate at which you withdraw the money is lower than the tax rate at which you contribute the money. Which is when you're making the contribution today, your tax rate is usually higher. Let's say your tax rate is 40% and you're contributing into your RRSP account at 40% tax rate, which means whatever you contribute in your RRSP account, if your marginal tax rate is 40%, you get 40% benefit of that investment. So let's say if you contributed $1,000, you get $400 back in cash because you save 40% on that $1,000. Now, when you're withdrawing the money out in your retirement, the tax rate should be lower. And the reason it should be lower is because now your expenses are less. You don't need a lot of money, rather you don't have any income at all, or you need less money and less expenses require you to generate less income. When the income is less, the tax rate goes down. So let's say the tax rate goes down from 40, which is today, to 30. So now when you're taking out that money, that $1,000 back, you're only paying $300 to the government as tax. So you earn $400, and then after, let's say 20, 30 years, whenever you retire, when you are withdrawing that money out, you're paying $300 to the government. So this $100 is kind of your saving. It is this saving which makes RRSP a better contribution versus TFSA. However, if you contribute at 40% tax rate and you're also taking out the money at 40% tax rate, then you are better off investing in TFSA. Now for that, I'll create a separate video where I take you through the calculation as to why, if the tax rate is same, which is at the time of your contribution and withdrawal, TFSA becomes a better investment return vehicle versus RRSP. So for that video, I will leave the link here above and you can check it out. But for now, let's go with this understanding that the tax rate, if it's flat, which is same at the time of contribution and at the time of withdrawal, then the return on RRSP is lower than TFSA. So you're better off investing each and every dollar in TFSA versus RRSP if the assumption is that the tax rate won't change. Now let me tell you why the tax rate won't change, because you might be thinking that at the time of retirement, my expenses are low. When my expenses are low, I don't need a lot of income. If my income is low, then my taxes should be low as well. So why is Behrouz saying that my tax rate won't change at all? And here is one scenario which I'll take you through as to why your tax rate might be same or higher. Let's go into the calculation. So I've created a model, and in this video, I will take you through the model to elaborate this point further. Now let me take a break here. In case you found value in this video, please don't shy away from pressing the like button. What it does is, it helps me stay motivated and also gives me the feedback that this is the kind of content you like, so I can produce more of similar content. Second, smash and hit the subscribe button, because this will help you get notified as soon as I create a new content and publish it. On this channel, I create 2 videos per week where I coach young and mid-career professionals on how to achieve career success and how to achieve financial freedom. Now let's get back into the topic. So here's how the model works. Here I have number of years, then I have the age. The starting age is 30 years, the retirement age is 60 that I've assumed, and the life expectancy that I've assumed is 85. So you'll work till age 60 and then you'll have another 15 years of retirement. The annual income that I've assumed is $100,000, which is flat year on year, sake of simplicity. Marginal tax rate is 38%. This I got from TurboTax website. So if you go there and you put in $100,000 as your income in Ontario, Canada, you get a marginal tax rate of 38%. With regards to RRSP contributions, I'm assuming that you already have somewhere around $50,000 in your RRSP account, which is kind of what you contributed or saved in your 20s. Then every year, I'm assuming you contribute 50% of your income into the RRSP account, which after tax basis becomes 20% of your income getting invested in RRSP account, which is the recommended saving that you should do. You should at least be saving 20% of your income if you want to retire or become financial free. This is one of the key standard advice that you get, which is save 20% of your income. So let's say if you're earning $100,000, your after-tax income would be somewhere around $73,000. 20% of $73,000 is $15,000. So you're saving $15,000, which is 20% of your after-tax income. Now this contribution is also growing, and I've assumed a growth rate of 10%, which is the growth rate that S&P 500 has offered in past 20 to 25 years, diluted by 2% of inflation. Now I know the inflation this year has been massive. However, historically the inflation rate has been somewhere around 2 to 3%. So for simplicity's sake, I've assumed 2% here. So our net growth would be 8% in this account. So we already had $50,000. We add $15,000 in year one, grow it by 8%, and we land at $70,000 200. In year two, we'll have $92,000 and so on and so forth. So by the time we reach the age 60, we'll have $2.5 million in this account, which is massive, which is good, which is great. Good amount for you to retire. But now comes the time for withdrawal. Now remember what I told you. The tax rate has to go down at the time of withdrawal versus at the time of contribution. And this is only for the investment in this account to make sense. Otherwise, you should be investing more in TFSA and not in RRSP. Here I've assumed that you are investing every dollar, which is the 20% of your take-home income, in RRSP. So all your investments are in RRSP and nothing in TFSA. So the withdrawal amount should be such that it should be lower than the income that you were generating, because it has to be lower for the tax rate to go down. So in the years when you were generating $100,000, the marginal tax rate was 38%. So in the withdrawal years, I've assumed we withdraw $75,000, because this $75,000 now becomes our income in those years. And the tax rate on $75,000, when I put it in TurboTax, is 30%. So if you are earning $75,000 in Canada, Ontario, the marginal tax rate is 30%. So you'll be paying 30% tax on the $75,000, and hence you only take out $75,000. So the tax rate goes down from 38 to 30. Now what we also need to understand is whether we would be able to use all this money by the age 75 or not, because we essentially in a way cannot take out more than $75,000, because if you start taking out more than $75,000, then the tax rate won't be 30% anymore, and it would be either 38% if you are taking out $100,000, or even higher if you are taking more than $100,000 out. So here I've assumed that we take out $75,000, which make mathematical sense for the return on RRSP to make sense. Now on top, I've also assumed that our investment will continue to grow. Now it won't grow at 8% anymore, because now you're retired and you want to be more conservative with your investments, and you decide to put it all in bonds. And I've assumed that our net compounding growth rate goes down from 8% to 2%. In 2%, I've assumed that the return is 4%, and then there's 2% inflation, so the net return is 2%. So $2,541,000 minus $75,000, growing the balance at 2%, lands us at $2,515,000. Similarly, we keep taking out $75,000 year on year, while the balance money also grows by 2%. So by the time we reach age 85, we will still be left with $700,000 in this account, which is a massive amount, and we don't want to lose this amount in this account. Rather, we want to make use of it, and we want to take out this amount earlier. However, if we are to take this amount out earlier, then we would be paying higher tax on it. So essentially, you were better off not contributing the entire 20% of your saving or the entire $15,000 every year into RRSP. Rather, you would have been better off by investing part of that amount in TFSA, which is all tax-free. So TFSA you can take out in one go in year one at the age of 60. You can just take out all that amount because you've already paid all the taxes that you had to pay on it. So let's assume they were $2.5 million in TFSA. You can take them out in one go. However, for RRSP, you can't do that. You have to break that amount into years so that you can lower your tax rate. So for the sake of this example, let's go back and see if we should only invest 10% in this RRSP account. So it is only if we invest 10% in this RRSP account that we would be left with around $36,000 in this account, which is kind of reasonable versus leaving $700,000 in this account. So if you have this scenario of income and you use these assumptions, in that case, you should not invest more than $10,000 of your income in RRSP, and anything on top should go into TFSA. I think it is very important for every one of us to run this model and make sure that we don't over contribute into RRSP to an extent where we are not able to use that money. And if and when we use that money, we end up paying higher cost. So we were better off investing it in TFSA as against in RRSP. Thank you for watching this video. Hopefully this video was helpful for you to now understand that there is a certain threshold or limit beyond which any contribution that you make in RRSP over TFSA is providing you negative returns. So you're better off investing in TFSA after that threshold or that limit has been reached. Thank you.